The purpose of the seminar is to be powerfully related to investments and give you tools to manage your strategy in a way that's consistent with your investing goals and in a way that's consistent with your views. Whether you have views on social responsibility, whether you have views on environmental impact, whatever your sort of criteria are, the technology is designed to accommodate and empower you around making all those decisions. I want to thank the Otis team. We are a growing group of people who have come together to sort of create the grassroots of this network, and we intend that it will become very impactful, and that people will see an opportunity for themselves and and choose to get more and more involved. Hi.
Hi.
I'm Bob.
Nice to meet you, it's Teresa.
Hello, Teresa. Welcome. And so what I'm going to do is first, again, I want to thank the Otis team, and you'll have an opportunity to mingle a little bit after the sort of formal part of the presentation is done. And what we're up to is creating a democratic approach to making investment decisions, and then creating opportunities for everyone to participate in the future of the enterprise. And I want to thank Ali for hosting the space. This was the first time we've really done it in this kind of formal format. So up until now, they've been kind of informal parties and gatherings and that kind of approach. So this is a little bit different. And we created Otis because we believe that people want to have more knowledge and control in their investments, that people want their values reflected in their portfolios, and that evolving data and visualization technology will allow us to take a leadership role in making that available to people in a way that's fun and easy to use, and that people can really relate to. And we'll get into some details as to how we're going to do that. And so I presume that because you're here, you have at least a passing interest in investment decision making at some level or other. And so I'd like to take a little poll and find out where people are in that kind of journey of discovery. How many people have got an investment account of some kind, of 401k, an IRA, something, and so keep your hands up.
Be proud.
So keep your hands up if you're in touch with that financial reality. You have a pretty clear idea of how it's performing. You know whether you're beating other people. You've got that kind of awareness of what's going on around it. So keep your hands up if you consistent with that. And then nobody. Okay, good, great, wonderful, absolutely. And brokers do a pretty good job of providing that better and better all the time in the last couple of years with the appearance of performance dashboards and all that kind of stuff. Not all that difficult anymore to keep on top of how you're doing, and even compare it to others, right? I'm sure you've had that experience. And then have you got, if you have any care at all as to whether or not your investments have got meet socially responsible criteria, or are you just out to make money?
Forward there, what's going on, just put the money in.
Yeah.
With my account.
With your trading account?
Yeah.
I get it. So and what about socially responsible stuff? Does that enter into your decision making at all?
Yeah, like I don't do cigarette companies and things like
Oh,
that.
good. So you have certain criteria that you apply. Some companies are beyond the pale. You wouldn't use them. What about short? Would you be short a company? Would you be short
I
tobacco?
never thought of that.
Okay, good. No, that's very helpful. Thank you. So first, a little bit background about myself. I spent 20 years as a quantitative analyst. I was pretty well known, particularly institutionally. I was ranked as in the all-star team of the Institutional Investor Research Magazine for 5 or 6 years in a row. Euromoney called me the best quantitative analyst in the world. And I will tell you that was 25 years ago when there weren't too many of us. But still, it was nice to show up and...
Don't sell yourself short.
now there's quite a large population. So I worked with Donaldson, Lufkin, and Jenrette, which was a very, very famous research shop focused almost exclusively on institutions. And I worked with institutions in creating investing strategies based on corporate accounting data. So a very fundamental approach. And what I brought to the party, I started my career in Canada, and what I discovered was that the popular models that were used at the time were static. So they were comparing all companies against each other at a particular point in time and creating, these are good and these are bad. And what I brought to that analysis was a detailed analysis of how the company was changing. So I made the proposition that how a company is changing is more important than how it is. So it's more important to identify good and getting better than it is to identify just good. So that introducing that dynamic was an important component of why, after arriving in the United States in 1987, I was top-ranked analyst within 2 years. Because it was very broadly adopted, institutions really liked it. And then in the late 80s, early 90s, the reliability of the publicly available data began to deteriorate. It was a period in which companies were doing acquisitions and divestitures more commonly, and the common practice of comparing this year's financial statement with last year's financial statement was no longer valid, because they weren't the same company anymore. They either divested a part of themselves or they acquired a part of another company, so it became an apples to oranges kind of comparison. And in 1994, the SEC began to display publicly available filings, which are required by every company to make once every 13 weeks, and have been making once every 13 weeks since 1932. In 1994, they became available on the internet. So my team and I left DLJ, and we declared our independence with the idea of creating an independent data capability. There's essentially 3 big data providers. There's McGraw-Hill, which owns CompuStat. There's Bloomberg and Thomson Reuters. And they all basically configure the data in the same way, and it's become very commoditized. And so there's not much of an understanding of how corrupt and uninterpretable and dangerous the data is. So what we did with this technology, we developed in 1999 and got a patent for in 2002, was to clean up the record so that we remove the impact of the distortions caused by acquisitions and divestitures, so that we create a smooth picture of how the company changes through time. One of the most famous investors in the United States managed the Magellan Fund for many, many years, and he said that investing was easy. All you have to do is to buy good companies and hold on to them. And so the traditional differentiation is to differentiate between good companies and bad companies, and we're in a share space where I'm sure there are lots of people that are in the room that have a pretty clear idea of the criteria that would go into defining the difference between a good company and a bad company. This one's, anybody want to give me one? Give me a criteria definition of a good company.
Well, increasing revenue.
Revenue, right. So it would be revenue growth, right? So that would be something that we would definitely want to have a clear picture of, right? And if we're looking at a company that makes a divestiture, then this year's income statement is going to be smaller than last year's income statement because it's a smaller company. So when you made that comparison, it would look like revenue growth was falling, when in fact it isn't, right? They just kicked a part of the company out. And the flip side is if they made an acquisition, it would look like the company had a big sales growth rate when it really didn't. It's just put 2 companies together. So creating that accurate measure of revenue growth is a really critical sort of top-line measure. Any
Debt load.
Debt load is a really good measure of the potential cost of the debt, so it shows up on the good company category as high or low interest costs, so that might be it. And it can be just simple debt load. Bad companies tend to have more debt than good companies do, according to a lot of people's criteria. Not necessarily so, but it certainly can be. Makes the company more risky, right? Any others?
Return on equity.
Return on equity. So then we've got a profitability measure, right? So we can measure profitability as return on equity, return on total invested capital, return on market capital, all kinds of different return measures, right? And so yeah,
Inside ownership.
Well, inside ownership is a criteria that one might make a selection on the basis of, but does it make it a better company because more insiders own it?
Well, I would think that because if insiders have a larger percentage or a percentage of it, it means that they believe in themselves as a company too.
Right, very testable, right? You could test that proposition. You could say, give me all companies that have big insider ownership, and then compare that with their some other criteria to determine whether or not that was a good or a good measure of goodness or badness, right? And so on the bad company side, of course, these would be all inverted. So what I want to introduce now is the idea that all of these things get better and worse. So we can have good companies getting better, and we can have good companies getting worse. And those might be things like falling revenue growth. Might be high, so it might be a high revenue growth company indicating according to a static criteria set that it would be ranked as good, but with the sales growth rate falling, maybe that's less good than it was in the past. So the direction of revenue growth might give us a measure of better or worse. Interest costs, debt load, profitability, insiders, all these kinds of things can be measured as good companies getting better or good companies getting worse. And similarly with bad companies, we can have bad companies getting better, and we can have bad companies getting worse. And so if we were to make investment choices, we would want to focus our attention on good companies getting better and bad companies getting better. And we would want to focus our sort of portfolio monitoring on any evidence that what we perceive of as a good company is in fact a good company getting worse. Okay, so how are we going to do that? Zelda, you're going to show me a picture of Apple Computer?
Yes, I will.
So we've been mining this data out of these SEC filings now since 1999, and we just this year created our 20-year record. So we're able to look at a 20-year history of the company's path through this matrix, from bad and getting better to good and getting better to good and getting worse to bad and getting worse. And so we have this ability to measure where the company is in that sort of quadrant of growth. Can you find it? It's in thegears.com.
I got it. It's taking a second.
So why would we bother measuring all of these metrics? Sales growth and interest charge and debt load and profitability and insider. Why would we bother measuring it? It's because we believe that there's a relationship between that and how the share price performs, right? That's really what you want to know with an insider trading report is, does this mean that the stock is going to go up or down? So what we want to know is the relationship between all these metrics and the share price. And so that's the first thing we do. Because we've got an 80-quarter, 20-year record, we can lay out the performance history of the company over that 20 years. You got it?
It's coming.
There you go. So this is the front page of the data management company that creates the data that drives Otis, and we're pulling up the picture of Apple Computer. It's just I should do it though. There you go.
The computer is very confronting.
And so what we're gonna bring up first is what I call the dominant factor page. And what that does is it displays over the record of the company, that's under active chart, it displays over the record of the company those factors that have had the biggest influence on the behavior of the share price. So when we go to ask the question, when do we buy Apple Computer, the share price of Apple Computer, the computer comes back and says that you buy it when the EBITDA margin rises, which is a measurement of profitability, when working capital improves, which is a measure of financial condition, and when total invested capital increases. Those are the three variables that define most reliably the performance record of Apple Computer. Total invested capital is 96% correlated with the direction of the share price over the last 20 years. EBITDA margin is 81%, gross margin 81%. So these attributes, these factors, are ranked according to their reliability in anticipating what's going to happen to the share price of Apple. So the way we're going to differentiate between these two categories and their two growth categories is by focusing our attention on those factors that have been the most reliable in anticipating the future growth, the future share price of the company. Okay? Now, what we've just described, total invested capital, earnings before interest, depreciation, and interest, taxes, depreciation, amortization, gross profit margin, selling, general, administrative costs relative to sales, shareholders' capital, cash flow margin. These are all industry lexicon, right? And the first thing that happens when people begin to hear that is they shut down right away, saying, "Oh my God, this is way too complicated. I don't understand any of this stuff. It's too much for me. Somebody else must have to do it." So what we're creating with Otis is a means by which all of this gets transformed into your favorite narrative, whatever narrative that happens to be. One of your favorite narratives might be fantasy football. So I keep, as a fantasy football player, you play fantasy football, right? Haven't you at some point ever? No? You don't play?
You're a young man!
You play sports games. But people are right on top of the numbers. They know exactly what's going on. They've got all these statistics for their players. They've got all these players lined up, and they're making all these calculations. And the first thing that comes to their heads is not, "This is way too complicated for me. I don't understand this now. Somebody else has to do it." They're engaged, right? And that's something that appeals to them. And so transforming all of this corporate accounting data into a narrative that's more accessible is what Otis is all about. Now that narrative can be a broad range of things. The one that we're starting with, and the one that we have the capability to move the technology forward with right now, is based on an agricultural kind of narrative. A garden or a farm or something like that. And that's why we're showing the agricultural images behind the Otis website. So the idea would be, if you're familiar with Farmville, the image of your farm will convey information about the quality and attributes of your stock or your portfolio, and you'll be able to see instantaneously that, oh my God, that crop is wilting, that land is becoming less fertile, look how parched it is, and there's no fertilizer. So you get the information right away, but it's not delivered in this industry lexicon that people tend to react negatively to. Okay, so that's the opportunity. That's what we're creating. So let me just. So can I go, Zella,
Yes.
onto if you go down here to the bottom and click on all facts. Click on your decision first. This is where Otis is now. This is a text narrative driven by the relationship between the fundamentals and the share price. Sorry, Zella, we got the wrong one. Go back. I want your decision. Oh, no, here it is. Here it is. Decision report. That's why I'm confused. Okay, this gets produced once a week. It's simply created from the data that comes out of SEC filings in the prior week, and it's a text description. The fundamentals did this, the sales growth rate did that, the margins improved such and so, historically this has been this important or that important, the stock is cheap or expensive, the stock is depressed or... So it's a standard lexicon. So let's go back. We don't need to, it's going to be an incredibly boring report, so nobody's going to be interested in it. So click on all factors. So this is a complete, behind all of this is a complete income statement and a balance sheet and cash flow statement analysis, starting from the top end of the income statement. Apple Computer reported its earnings yesterday. They reported sales of 22%, so almost identical to the sales growth rate that they had achieved in the prior quarter. So sales growth will remain, possibly even uptick, might flatten out here a little bit. Gross profit margin is up, operating costs are down, tax rates rising. Keep go down, Zella. These are inventories, receivables, and depreciation. This is the EBITDA margin. This is capital expenditures and free cash flow. Keep going. So that's the income statement analysis. Then we do a cash flow statement analysis where we differentiate between working capital, cash from operations, and cash from operating activities. Keep going. And then we do an investing analysis, try to figure out where the company is spending its money. So you can see that since 2004, Apple Computer spent about $8.50 a share in capital expenditures, but it spent $25 a share in investing in securities. So it's spent much more purchasing securities than it has investing in its own capital expenditures. And then this is kind of interesting too. This is cash going out to shareholders. This is total invested capital, and this is debt. So over the last couple of years, the company's taken on quite a substantial volume of debt in order to pay out cash to shareholders in the form of, keep going down, in the form of share repurchases. So shares outstanding has gone down from 6,685 million down to 5,802 million as they've repurchased this stock with debt. So they're goosing the bottom line. They're making things look better than it really is. Now, things look pretty good, but it is something we definitely want to be aware of, that there is this is a deterioration in the earnings quality at Apple Computer. And there are a couple of sources. First of all, there's the huge investment that they've made in securities. As we have an idea what the return on securities is, it's pretty darn low. And yet we've got this amazingly profitable company that keeps investing more and more and more in securities. It's not all that difficult to predict what's going to happen to their profitability if they keep doing that. Okay, and at the same time, they're increasing the debt load in order to repurchase stock, and that makes their profitability look better than it really is. So there's those kinds of things going on, and it's only through this really substantial, detailed analysis that we get to the bottom of that. But then we go back to our lexicon again, and we realize that all may be true, but if it isn't consumable in a way that people will actually say, "What? I'm going to make a decision about Apple Computer," then it's not going to be very helpful or empowering. And that's where the conversion into the alternative narrative, whether it's a fantasy sports narrative or a Farmville narrative or whatever narrative we discover is going to be popular with people in creating context for their investment decisions. Okay, so what we're committed to is certainly for everybody who gets involved early, but generally we're committed to everybody having an opportunity to participate financially in the growth of the network that will be Otis. And the network is already underway, and we've already got a couple of people who are creating strategies and getting followed by participants in Otis. So what I want to do is to just spend the last few minutes describing the ways that we have to participate. And the conversation that we are most interested in having is a conversation with what we call an incubator client. And we have a registered investment advisor. I'm a chartered financial analyst, and I'll be if you were to choose to be my incubator client, I would be your fiduciary. And we would have a traditional investment management relationship. I would charge you a fee, and I would create for you either a new investment strategy, or I would provide you with empowerment around managing your existing investing strategy and presenting it within the game narrative. So it might get presented as a fantasy football team. It might get presented as a greenhouse garden. It might get presented as a farm. It might get presented in whatever narrative ends up being the one that attracts the most attention and creates the most traffic and the most interest in the idea of an alternative narrative for your financial life. There's a 2% fee, so it's not a discount fee. It's not a huge premium. If you're with a big broker, there's a good chance that you'll be paying a higher fee now. And the intention is that you as an incubator client will receive 50% of the future revenue generated by the game. We think that the game by 2025 will be a $50 million business. Half of that, $25 million, will be distributed to the incubator clients, and that'll be a 100% annual return. We're capping incubator clients at $25 million, and the intention is to create a 100% annual return for incubator clients by 2025. The projection calls for a 30% return by 2020. So just in the next couple of years, your relationship and participation in Otis will have a huge impact on the returns of your investing strategy, independently of how well your strategy performs. Because there's no relationship between performance and compensation. Incubator clients get paid right off the top, so they get paid 50% of revenue. Then the next opportunity to participate is what we call a passive player. And a passive player owns an index benchmark. And as the owner of that index benchmark within the space, if other players choose to follow that benchmark, then you get paid. So the bigger the network gets, the more people are going to be interested in following certainly the popular benchmarks. And as a result, people who own those benchmarks stand to make many thousands of dollars in return for their ownership of that benchmark within the game. Obviously, there's a limited number of benchmarks. And as I mentioned, the incubator client opportunity peaks, or caps, if you like, at $25 million in 2025, and that's 100% annual return. But there is no cap for the players' opportunity to participate within the game. So when the game has got 1 million players, the person who owns the NASDAQ is probably going to be followed by 10% of those players, I would guess. I mean, the NASDAQ is a very popular index. And as a result, be generating very, very substantial income stream from their ownership and their prescience, if you like, in claiming ownership of that benchmark index. That membership is $100 a year, and to me, for people getting involved now, that's the biggest payoff. It'll be really huge, I believe. And then the third one is what we call an active player membership. And what you're doing as an active player is you're contributing your investment strategy to the game space. And presumably, you believe that your investing strategy is a good one for you. And as a result of that, it's very likely to be a good one for millions of other investors who are like you. And as they choose your strategy to follow, in other words, if they choose your strategy to be a competing football team or a competing garden, or if they choose to follow you in their game configuration, you get paid. And so for the popular strategies within the space, and there can be, of course, an infinite number of possibilities, including something really exciting like an aggressive option strategy, that people would potentially follow and generate a significant sort of income stream or revenue stream for you that's sort of independently of how well you do with your option strategy. Now, there is a presumption that you're going to have to do well in order to attract that interest, and those people who do well will be rewarded within the space by people wanting to follow them. But it's not necessarily only about investment performance. It could also be about sort of a socially responsible view. So I might choose to follow a strategy of somebody who has a socially responsible, sort of maybe even anti-something, could be anti-tobacco. I'm going to follow this guy because I know he's anti-tobacco. I never have to worry about tobacco shares showing up in my sphere of vision and influence because I'm following this guy who I know doesn't own tobacco. Could be that. So there are various kinds of criteria that people might use to decide who they want to follow. For me, using the farm metaphor, I've got my farm in the center of my screen, and I've got my neighbors arranged around it. One of the neighbors that I'm going to have is the NASDAQ. I just want to know whether I'm beating the NASDAQ, because if I'm not, it's easy enough to buy. You can just go out and buy the NASDAQ. And so if I can't beat the NASDAQ, then what the heck am I wasting my time for? Unless it's about entertainment, in which case then maybe I have a different criteria, but I'm going to have the next. I might also have my strategy. So I've got a CAM strategy. I like companies that have sales growth of greater than 20% and interest costs that are falling and debt loads that are improving, and they're profitable and improving companies. So I've got a set of criteria that I use, and I want to know how it performs, so that I can compare whether my portfolio, which is names that I've chosen from that strategy, is doing better or worse relative to the strategy. So that's going to be one of my neighbors. Another neighbor that I might choose is I want to know my boneyard. I want to know everything that I've sold in the past. So, because clearly if I've owned it, then I've got a positive view of the company, or at least did have at one point, and I might want to keep up with how that company's doing now that I don't own it, so I might have a boneyard. I might have an asset allocation place where I'm looking at whether or not I should be in this portfolio at all, or whether or not there's a completely different asset class that I should be looking at. So all of these things will be chosen by each participant, and each choice implies that all of those choices get paid to the follower. So the opportunity is that you generate a very significant revenue participation through your participation in the game, either as a incubator client, where the payoff is by far the biggest, as a passive member, or as an active member. So we're going to provide an opportunity for you to make a choice around that if you should care to do so. And then the last membership is what we call a spectator. And a spectator is a free membership, and I encourage you, everyone, to sign up for that. We're on an amazing development path now. We'll have within the next few weeks our first prototype of what the transformed narrative will actually look like, and we'll be within the next 6 months in a position where we'll be launching the prototype into what we intend to be the growing networking community that we're building around this technology and around this capability. At the root of it, it's all about data. And of course, we hear that all the time. There's this huge data story going on now about the reference is almost always to big data and unstructured data. But the value in data analysis is almost always in the nature of its structuring. This is very, very highly structured data that we're able to differentiate between cash flow per share and cash flow from operating activities per share, which is removing the influence of working capital. To have that distinction is not all that important, as you can see, for Apple Computer, but for many companies it's hugely important because the company has got all kinds of activity going on in the working capital account. So being able to get at that detail and being able to convey it in a way that's consumable and shareable is the basis of what we're creating with Otis. And so let me just check to make sure I'm not missing anything. And so yeah, so we've got Zelda is going to register people who are interested in the active or passive player, right? And Jed is going to register people who are interested in the free membership. And if Incubator Client is a possibility for you, then I invite you to talk to me. Incubator Client is a $100,000 minimum. And so I've done a lot of talking. I wonder if I've sparked any questions, any observations, what's on your mind? What do you think? Please.
Well, is this these three options you or four options you mentioned? Is it all like we have it like written out somewhere? So
Yes. So if you would go back to Otis Wealth System database website.
The interwebs are not cooperating.
Here we are. And if you click on, why can't we see the menu here?
Yeah, that's the tool.
Hmm?
Thing on the top right is
Yeah.
that's
If you click on, I don't know why it's not displaying the menu. Can you click on that now? There we are. And you click on register. It'll give you all the options and what's provided with each. As a spectator, you have access to all the company reports. So for people, anybody doing venture capital, anybody doing funding, and just because it's Alley NYC, I'm expecting that people are going to have an interest in comparables. And so as a free member, you have access to all the company reports, industry reports, sectors, and you're able to make comparisons with others in those categories. And so if you were doing if you're doing evaluation, the company reports might be useful. If you were looking for comparables, you'd find company reports useful. Of course, the industries and sectors, if you're doing a business plan proposal or anything like that, this is just amazingly powerful. data and information about those categories. And then in the passive players, you devise a sell strategy, you visualize your portfolio against others, you create an investment strategy if you want to around that passive investing vehicle, and then you get paid from followers. And then as an active player, you get paid from followers, and then this one, which I'm hoping everyone will buy, is both passive and active. And so you get paid through your ownership of the passive strategy, and you also get paid by your active strategy. And what people are doing is they're buying this membership and then creating a custom passive index. So one of our players has a particular interest in companies that are good to their employees, and so he's creating a universe of companies that are good for their employees, and he calls that his benchmark. And then he's creating a portfolio of what he considers to be companies in the good and getting better, or possibly bad and getting better category. And then he outperforms his benchmark, but his benchmark is still out there to be followed. And so that provides an opportunity. If you had a similar kind of affinity, if you wanted to, I'm only going to invest in companies that are good to their employees, then it's very possible that you would follow both his passive and his active strategy, in which case he gets paid twice. Any of that resonate over there? Does that make any sense to you?
I just want to know, like, when you popped in Apple, can you pop in any
company. Yeah, we cover about 1,500 right now. And the technology is really evolving very, very quickly. Because it's a learning procedure, we're able to add new companies very, very quickly. And so we can, it's very possible that if you had a penny stock interest, we could create a penny stock product without too much trouble. There's also been a really, really interesting change in technology recently called with the appearance of a new internet document called an XBRL filing. Have you heard of XBRL? XBRL is similar to HTML, except that it's specifically designed for the presentation and analysis of tabular data. And it's very rapidly becoming a global standard. And what it's doing is it's creating access to financial statements for every company in the world. So that it won't be very long before we'll be moving out of the SEC filing population, which is where we're currently sort of stuck, because it's SEC filings that are being presented in the format that we're interpreting with this software. We'll be able to take that into every company in the world that creates an XBRL filing. So those will be most of the large companies in the world. So the intention is to create this as a global capability so that we could create, for instance, the same strategy if you were managing a higher return, a higher risk option strategy in US stocks. You might want to move the whole thing over into German stocks and try the same thing. And therefore dramatically expand your potential follower base, and therefore generate that much more income for yourself. So we're expanding in two directions. We're expanding in terms of the volume and capability on the data side, and then we're also expanding in terms of growing out the membership that will provide the opportunity for everybody to get paid.
So one of the things that you've created is what it will look like in the future, right? The opportunity in the future. And for each of these opportunities, including incubator client, what is the opportunity right now?
Okay,
what
so
does it look like?
Thank you. So right now we're dealing with a file exchange interface. So every week companies make SEC filings. Last week there were in our database of 1,400, there was about 100 companies that reported their SEC filings last week. And on a weekly basis, I create a file that contains everything that has passed through a set of your criteria, and we'll, as an active player, we'll discuss what those criteria are. It could be population-based criteria, no tobacco. It could be profitability-based criteria, only sales growth rate more than 20%. It could be financial condition-based criteria, or we want companies that can pay their debt load and dividends. It can be whatever kind of criteria is accessible in a data context. And then other kinds of criteria, like I wouldn't buy Monsanto if my life depended on it, I don't care how good the numbers are, that kind of criteria gets overlain. So I'll send you this file, and pass through all of your tests will appear Monsanto. And you will say, no way, I'd never buy Monsanto.
And so you would indicate in that file that this is a company that you never want to invest in, you never want to see it again. We ship that back and I update your record. And it says, okay, from now on, that stock, that company, Monsanto, is no longer in Monique's universe. You don't want to see it ever again. Or you might say, well, I don't want to buy it now, but for whatever reason. But I might want to look at it sometime in the future. In which case you would indicate it as what we call a fail. So it's not rejected, but it's failed for this quarter, and then you might look at it again, or it might appear again sometime in the future. So in that process of exchanging this file weekly, through one data cycle, 13 weeks, you end up with a portfolio assembled, and you end up with the beginnings of your benchmark index, your company population. And that performance is being recorded. And so once the game transforms into a more appealing visual kind of narrative, your track record will be both the longest and it will also be the most disciplined. So it'll look the best within the space. And so as the population of people grows, people using the space, it's much more likely that they'll choose those strategies that have got the longer track records than the nicer appearance. So the intention would be that people get involved early and begin to create their investing experience within the existing sort of cumbersome file exchange that we have now, will be rewarded in the future with a track record that will be the longest within the space once it begins to appear. Does that make sense? And there are several people in the room that are up to that. So when we break for refreshments, please ask for it. In fact, maybe that would be the thing to do, right? To see whether
I really just want to check in and make sure there are no more questions. And my request to create the opportunity for incubator client, what it looks like right now.
Yes, so for an incubator client, the performance of the strategy is less important because the revenue participation is independent of how popular you are. The revenue participation is 50% of the revenue right off the top line, regardless of how the strategy is done. So you don't need to change your strategy to be an incubator client. You do exactly what you're doing now. All you're doing is changing your investment manager. And what that does is provide you access to that revenue as the network grows. And it's a traditional investment management relationship, so you don't even have to be involved if you don't want. I'll implement your strategy, and you can have whatever involvement is comfortable for you. I have one incubator client who is a medical doctor. She doesn't have time to look after her own money, but she wants to invest in companies that she knows. So we have a conversation periodically about what's available to her. She makes her choices, I implement, and so it's that kind of a investment management relationship. I have other investment management relationships where they don't have time, don't have an interest, don't want to have anything to do with it, but they do know what they want to do in terms of the strategy. That's a very traditional investment management relationship, and I execute that for them. And the opportunity for them is to not only get their strategy executed in an independent data set, but also an opportunity to participate in the culture, which is
And access to you.
and of course you get access to me. And the importance of independent data, I think, can't be understated. When you consider that there are trillions and trillions and trillions of dollars that are being managed on the basis of this data that is noisy, corrupt, unreliable, and dangerous.
And how much does it cost to get access to that data right now?
Well, a Bloomberg terminal would be, how much is a Bloomberg terminal? $70,000, $80,000 a year?
It's real time, but how much does it cost to get access to your independent analysis, your data?
Well, as a spectator, it's free.
Yeah, there it is.
There are all these companies, all these reports that are available for free. And then as a passive player, you get
Getting access to the information
Yes.
is the answer I was looking for.
Okay, good.
That's the underline.
Yeah. Please.
It says, get paid from followers. What do you get paid? I mean, how does that?
Well, I think the way it's going to evolve is into something that we call Otis coin. So it'll be an inside the game currency, and it'll be exchangeable into dollars. So everybody who buys a passive or an active membership will get 10 Otis coins that they can use to arrange their followers, to arrange their following, if you like. Or purchase other things that will be made available within the space, and we can talk about what some of those other things might be. So it's going to be, so each follower pays you $1. So if you have 1,000 followers, you get your revenue stream is $1,000 a year. If you have 1 million followers, then it's going to be that kind of number. And the intention is that this is just keeps growing and growing and growing and growing, so that, and it becomes a global phenomenon, so that the context that we're creating with the data becomes globally available. And XBRL will allow us to do that, which is something that's quite new. I've been stuck in the United States for 30 years, really keen to globalize, but not having the technology to do it. And with XBRL, the technology is there now, so it's going to be really great.
And inside the shared context, something else that we spoke to a little bit, but is what I'd like to put in, is that we have influence. If we all have the access to this data that is telling about companies, and we all make decisions based on that data, but also say our personal influence, then all of a sudden, if you have, what was the company you mentioned that's super evil about the food? Monsanto. I mean, there are like thousands of people that are absolutely just hate this company. And imagine if those people took an action inside of their investment. And then all of a sudden you have 1,000 powerful investors unwilling to invest in a company.
It is possible that there could be some corporate governance influence through the membership of the game. It is possible. I mean, that would require pretty good size.
And that's what we're creating,
Yes.
dang it.
Yeah. And so the intention would be that there would be influence from the community certainly as to what's a good company and what's a bad company, and things that they might do and things that are missing. If you see a company that's got unusually low operating costs, it's unusually high gross profit margin, so that it's likelihood that they're going to be able to push costs down or margins up in the future is limited, and they're not making any capital expenditures, then the question is, what are they going to do in the future? And that might spark a debate, might spark a conversation, and that debate and conversation will be available within the space, and people creating those conversations will have an opportunity to get paid for them. So that what's completely new about the Otis network compared to other kinds of networks that are out there, like Motley Fool, is that there's no opportunity to get paid with Motley Fool. And so this is, I think this is an important distinction that Otis contributes. Okay? Anyone else?
Mine was your return last year.
What was a return last year? Zella, will you give us take us to the models page?
On the Otis website?
Yeah. So we have a, it's going to be under products. We have a group of investors who have created incubator clients already. And so if we look at active, hold on, keep going. Here we are. Investing strategies. Then we have a set of investing strategies, one of which is Green Machine, which is a socially responsible strategy. High sales growth, which is focuses on companies with that attribute. Luxury liner, which is a hedged strategy. Earning surprise, which is a particular set of a pattern, if you like, of criteria, and behind each of these is a performance record. So the performance is going to be a function of your investing goals. So if you had a make as much money as I possibly can kind of investing goal, then you might be looking at something like the high sales growth model. If your investing goal is I don't want to lose money under any circumstances, which is quite a common one, then you might be interested in looking at something like a hedge fund strategy. And the intention is this is not a get rich in the investment world product. The intention is not that you're going to unless you were to create something like a high-risk option strategy or something like that, the likelihood is that if we produce a return of a couple of hundred basis points better than your benchmark, we'll be doing very, very well. And that's about all that we're really out to create for people, is an opportunity to produce a few percentage points better than they might have otherwise. Now, we will support a very high-risk, high-return strategy if that's one that you have an interest in. And just to answer your question precisely, if we look at the high sales growth strategy, we have to log in. Oh, that was a nuisance. So that's a breakdown. Actually, that's not supposed to happen. We're supposed to be able to see those without. So peek on. You can log in for me. This is RGAY. Yeah, and this is Gears with a capital G, EARS 2015. That's it. And I'll fix that. We're not supposed to have a login intervention. You should be able to see the returns from the. I'll try Gears 2014.
It's the username, it's RGA1, isn't it?
Yeah.
So it only says RGA.
Is it RGA?
No, RGAY is correct. No, there's no
Okay.
one.
Freaking me out!
Right.
I heard one.
And behind each of those strategies, and I think there are, what, 5 or 6 out there now? And there are another 5 or 6 that have just got started in the past sort of 8-10 weeks, so they're not being displayed on the website yet. But I do want to get a specific answer to your
I'm
question.
going.
Here we are. There we are. So this describes it, and then it shows the performance record. Hope I chose one that has a decent performance record. I should have shown Ched's. Yeah, so the portfolio is, this is the market, this is the benchmark, the SPX, the S&P 500 index, and this is the strategy. So the strategy, and it's been going since since the first January 2014. And it got off to a nice start, then the market caught up to it, then it took a dive here in the market correction in 2014, and it's recovered up, and now it's maintained that gap. So what we really want to see is we want to see the blue line on top of the green line, we want to see that gap open up. That would be ideal. And, but in the meantime, it's produced a better than benchmark return, which is what we're after.
Is the S&P 500 where you base most of the strategies against as a benchmark?
Well, again, S&P 500 is sort of big ugly names, right? So if you had a big ugly kind of strategy, then that would be the appropriate benchmark. If you had a sexy strategy, then maybe you want to look at the NASDAQ. If you had a small company strategy, then maybe you want to look at a small company index. So that the strategy you choose to benchmark yourself against is largely a function of what your strategy is.
Okay, got it.
So you create a strategy, right? And it's kind of just mimicking what the strategy would have done in the market, or is it?
Well, it depends. This one is an incubator client. So this one is actually a real portfolio. And this one is actually live. And then we have people who are playing just as a game, in which case there's no money involved. The strategy is still purchasable within the space, so it's still, you still have an opportunity to generate revenue from followers, and you don't have to have money involved. Steve has a long-short strategy that he started up 10 or 12 weeks ago, and he's done, he's not done very much with it. It's just ticking away. We're going to see how it does, and ultimately it'll get displayed in the space, and people who have a hedge kind of strategy might be interested in it.
So I'm your average teacher,
Mm-hmm.
and I am concerned about retirement.
Right.
And so I've been paying into a 401k for the last 10 years as a teacher,
Mm-hmm.
and I have accrued
Since you were.
We've accrued $250,000.
$250,000, and I can't retire off of $250,000.
No way.
So, and what's likely is that in the next 10 years, I will accrue another $250,000
Okay.
unless I do something about it,
Okay.
correct?
Right.
And my current, and I don't have time or, wits about me when it comes to money. And my current financial advisor has got me in a general kind of,
He's got you in a strategy.
got me in some kind of strategy, I don't really know anything much about it. And,
Exactly.
and it's returning
Whatever it returns.
whatever it returns.
And you might be happy with it. Your investment advisor may have, really convinced you that this is an extremely good strategy for you. In which case, put it over into the Otis space, monitor it on an ongoing basis, create a track record around it, and create followers around it. Because there are millions of teachers out there that are in the same kind of position and might want to be following you as the owner of that strategy.
And at the very, before I have followers, I have a checks and balance system. I have some way of, I have a third-party data set
Yes.
to compare my actual performance against.
Yes.
As opposed to whatever it is that my financial advisor is telling me so that I continue to pay my financial advisor.
Exactly, and you might be empowered to have that conversation with your financial advisor.
I
You
might
might say something like, look, my portfolio has got a sales growth rate of -5%. That doesn't sound good to me. What should I do? Or what can I do? So you might end up actually modifying the strategy.
Or asking him what he recommends and
Exactly.
seeing if he's on the same page that
Exactly.
you are.
So the intention is not necessarily to disrupt what people are already up to. The intention is to create more empowerment around what they're up to and getting paid from the simple notion that if you're in the space first, then people are going to be, you'll have a track record where others don't.
So most financial advisors aren't using your data.
No.
So what's different about how your data is presented as compared to what they're using? And why does that give you the advantage that you feel it does? And how does that apply to Otis customers?
Okay, good. So if a financial advisor is actually creating a stock portfolio, which is rare anymore, most financial advisors advise you to own big populations of stocks, either in mutual funds or in exchange traded funds, but they're not creating an individual stock portfolio. That's where the value of our aggregate stuff is so good. So what we're doing is creating sector analysis, industry analysis, benchmark analysis, so you're able to compare the NASDAQ to the S&P. So what that might do is to empower you to ask your financial advisor, why do I own the SPDR when the 1Q has got twice the sales growth rate and has got much better looking fundamentals? So it would empower you to ask that question, particularly if you were in a situation that Zelda described, where you've got 20 years before retirement. In which case, maybe the stodgy old S&P is not what you want. Maybe you want something with a bit more zip. And to empower you around being in that query. The other possibility is that the financial advisor is actually building you a portfolio. In which case, there might be a couple of things that you would be interested in. And that is, how does my portfolio compare to my benchmark? If it's doing well, what attributes does it have that might be contributing to that? And if it's doing poorly, then what attributes that we might be able to bolster up in order to produce a better result. And then there's the whole question of